One of the big debates among economists going into 2024 is the timing of Fed rate cuts. Deutsche Bank projecting a mild recession that will lead to 175 basis points in cuts starting in the first half of the year. Pretty aggressive compared to the market, which according to the bank is now pricing about 100 basis points of cuts. Here to break down this forecast, we've got Matthew Luzzetti, who is the Deutsche Bank Securities chief U.S. economist. Matt, always a pleasure to grab some time with you here. All right, just kind of broad strokes, lay out the thesis here for us because you got some folks out here scratching their heads.
Yeah, I think really what we've seen for the market over the past week or so is this acceleration of focus on rate cuts. On our view, I think the Fed cutting rates next year is pretty clear. We have, as you mentioned, this mild recession view. The unemployment rate rises to about 4.5%. Inflation is on a downtrend. And in that world, I think it's very clear that the Fed doesn't think they have to sit at 5.3% on the Fed funds rate. They can begin to cut rates relatively aggressively. And as the chart that you just showed shows, actually, our rate cuts are less aggressive than what typical policy rules that the Fed would reference would suggest. I think where the big market debate at the moment, however, is, and it was set off by Governor Waller last week, how aggressive might the Fed be willing to cut rates in an environment that is not a mild recession? If we get a soft landing and inflation's coming down, then can they still cut rates? And the market over the past week has taken the view, yes, they can, and they can do it relatively early.
And do you agree with that sentiment?
I think that there's a lot of enthusiasm around it at the moment.
Mm-hmm.
Over the past week, we've seen the market move to almost price a full rate cut as of March. It's now pricing about 125 basis points of full cuts in 2024. I think you do need to see economic weakness to get a rate cut in March. I don't think that under a soft landing outcome where it's just inflation coming down, that the Fed is cutting rates as early as March. I think that they're worried about repeating the mistakes of the 1970s. I think they're worried about easing financial conditions at the moment. So I think in order to get a rate cut as early as March, which is possible, I do think you need to see economic weakness with the labor market softening and the unemployment rate rising about 4% by that point.
So, Matt, I think a lot of people are asking exactly what that weakness needs to look like. When you take a look at that unemployment number, in order for the Fed, in your view at least, to feel comfortable cutting potentially in March, how high does that unemployment number need to rise then to?
Yeah, I think they need two things. They need to have very clear confidence that inflation is on a downtrend and is on its way to 2%. And so in my mind, that'd be 0.2% type prints on a monthly basis for core PCE. And it would be the year over year rate for core PCE dropping below 3%. I think that's kind of just this important threshold for the Fed. If you couple that with an unemployment rate that has risen above 4% over a relatively short time horizon, it would generally be consistent with a labor market that's weakening and mild recession type dynamics. I think that that's an environment where the Fed is worried about whether or not they're going to be able to achieve their soft landing, are concerned and have uncertainty about whether or not a harder landing is possible, and therefore would likely begin to cut rates.
It is a Fed that's been able to lean on the employment situation in a tight labor market. How much longer do you believe that could still be the case, or is that starting to show some weakness from your purview?
I think it's certainly starting to show some weakness, but it's showing some weakness from some extraordinarily tight and extraordinarily strong levels. Last month's jobs report was one where I do think that you're beginning to see some of the weakness broaden out. You saw the unemployment rate rise to 3.9%. We saw the diffusion index, so how broad-based our job gains really begin to decline. You saw permanent job losers rise. And so all these, I think, are evidence that the labor market is very clearly slowing. I think it's critical whether or not we get continuing evidence of that over this next week. The JOLTS report tomorrow is really important. Obviously, Friday's jobs report is important. And then over the next several months, the labor market, from my perspective, is in this really critical juncture. If it stabilizes near these current levels, then you get a soft landing that everybody is very hopeful about and that the market's increasingly priced. But the second derivative on these moves is pretty negative. And if you continue to get a softening and weakness, then I think the market begins to get concerned about these somewhat worse mild recession type dynamics.
Matt, how tough is it to provide these types of projections given the fact that there is still so much uncertainty when you compare it, historically speaking, to some of the recessions that we have seen played out in the past, at least up until now? This situation seems to be a heck of a lot different.
No doubt. I think, coming out of this very unusual environment from the pandemic, the fiscal stimulus that we've had in the system, the ability for households and businesses to lock in low interest rates, it's created tremendous uncertainty about the pass-through of monetary policy tightening into the real economy and the impact that that's going to have. And I think if you take a step back and 2 years ago, 18 months ago, if we thought the Fed was going to raise rates by over 500 basis points over that period, I think most people would have anticipated that we would have gotten a recession at this point in time. Certainly we were of that camp. But it hasn't happened. It hasn't happened because the monetary pass-through hasn't been as significant. And you've had an economy that is still healing from the pandemic. The question, I think, now just going is, does this tightening begin to hit the economy a little bit more significantly than it has over the past year? We think it does. We think you're starting to see some evidence of that.
It's been interesting to get some New Year's resolutions from chief investment strategists at some of the firms that really are looking across Wall Street, looking across the inputs of the economy as well, and trying to best position their portfolios. But from your perspective as a chief economist, I would wonder, is the resolution to just let a recession happen so that we can finally get past it and on the other side? Because ultimately you have some consumer cohorts that have already felt like they've been in a recession, especially on the lower income quartiles, for the better part of several months now.
Yeah, now that has happened given price changes and given tightening credit conditions. But those outcomes would only be worse if we get a recession. You tend to have that during recessions, unemployment rates rise, job losses tend to be concentrated at the middle and lower end of the income distribution. And so I do not think we should believe that they'd be better off if we do get a mild recession. The Fed is still holding out hopes, and I think it is possible that we get this soft landing dynamic playing out, where you get this immaculate disinflation, inflation comes down, the Fed is able to cut rates because inflation comes down without seeing those meaningful job losses. That outcome is far more likely than I thought 12 months ago. As a result, we are more optimistic on how this plays out. Our baseline is still that you get this mild recession view of the world. But in terms of a New Year's resolution or what you would hope for, it really is this soft landing playing out where the Fed is able to cut rates purely on an inflation story and not because the labor market is weakening.